are literally shaping the planet.
Purpose is the only pathway to a regenerative future.
We have a choice to stay with the status quo or to change.
What is the point of trying to be just resilient when we can actually innovate?
So good afternoon, everybody. And Zach, thank you very much to you and the entire Shadow Ventures team. I want to spend about 20 minutes going through sort of our thoughts on ESG and healthy buildings and how they're creating and driving value, and then make sure that we've got enough time for a conversation at the end and any questions you might have. So just really quickly, because I just want to sort of set the context. So prior to founding GreenGen, as Zach mentioned, I spent 20 years in real estate private equity. I started at J&B Realty in Chicago when it was the largest real estate firm in the country, and spent a decade at Starwood Capital as the founding partner of Starwood's international business in Asia and Europe. And this firm was founded really in response to the 2008 crisis. Essentially, as revenues collapsed and asset values collapsed, we began to look at expenses for a way to mitigate this collapse in cash flow, and stumbled upon energy as a big line item that we didn't know much about. And today we've built a company that's an award-winning company that operates in the intersection of energy, real estate, capital markets, and technology, a somewhat differentiated sort of perspective. I'm sitting in Washington, D.C. We also have offices in London, Tokyo, and Shanghai, where we do our work primarily for investors. The work we do, we have 5 businesses here. The primary business I'm going to speak about today is what we call solutions. And that's where we integrate and think about assets and portfolios. We assess them, we engineer the solution, then we execute them for an outcome. That outcome is essentially always a financial one, where we're driving the asset value and having a co-benefit of sustainability and resiliency. But we also have an energy data analytics business, Emerald. We have a venture capital platform where we're investing in technologies that impact the value of assets. We also have a trading platform where we are creating and trading voluntary carbon offsets, either from permanent reductions of energy in the built environment or from project development that mitigate, reduce, or sequester carbon. And then finally, property, where we're working on projects and deals that have a unique energy opportunity. The work we do is about 75% of our work is for investors. Most of it is for the large, either private equity firms or real estate opportunity funds, and we're doing this work all over the world on their behalf. So I want to sort of divide this into sort of 2 pieces. I want to think about and talk about sort of what we have always done for the last 9 years and what we would be doing in a normal times. And then I want to talk a little bit about sort of the world as it is today. I often call it a post-COVID. I'm reminded that we're not by any means post-COVID or post-anything, but we're very much in the moment. And so really talk about sort of what it looks like today, living with COVID and thinking about real estate. When we began the business, it was very simple. People had business plans for their assets and their businesses. What we found as we spoke to them is that for the most part, they often had an incomplete business plan because they didn't have an energy plan. They didn't have a sustainable business plan. And it's thinking about the energy costs. It's thinking about the health and safety of a building, the wellness, that we think when integrated properly, working with and conforming and consistent with the debt, the leasing plan, that's when you have an actual business plan. The sustainable business plan is a little bit different today. When we began, we didn't think about a lot of these issues, but today we're really thinking about 4 key things. The ESG strategies, thinking about what those are, how is the asset performing, and how does that drive value. We're thinking about energy efficiency. That's the traditional work that we've always done, where we're thinking about energy and to some extent repairs and maintenance and insurance. We're reducing operating costs. We are increasing the cash flow of the asset. We are creating enterprise value when you go and cap that increase in asset value. And we are driving fees and promote for our clients. Today, we've now added a screen and element of health and wellness. This was something that everybody thought was important in the past, but nobody really wanted to spend any money on. No one was investing money in improving the health or wellness of the building. That is very different today than it was, say, a year ago. And then finally, resiliency. If we learned anything in the last year, with 5 named storms in the Atlantic Caribbean this past week, wildfires on the West Coast, we've learned that resiliency is now not just something, it's a nice to have, but it's essential to having an asset that can withstand the various shocks, be they environmental, climate, or other things, financial, as we go forward. And so it's these 4 things that really, when brought together, align with sort of what we call the traditional business plan and create or maximize enterprise value. I just want to spend a moment, because some of you may not actually, may hear the term ESG, but may not be familiar with exactly what it is.
Bradford, excuse me, I just wanted to jump in real quick. I apologize for interrupting. You may want to go full screen to avoid notifications showing, if that's a concern to you.
Okay.
It's probably up in the view or window menus.
Apologize for that. Thank you very much.
It's actually Dean from Kairos who pointed this out to us. So thank you to Dean.
Yeah.
Perfect.
No problem. And I should have closed my Outlook. Hopefully nothing came through that would cause me alarm. No. Okay, good. Thank you, Zach. So ESG, we often, I think most people sort of think of the E as energy. In fact, it's environmental, social, and corporate governance. All these are key trends and key things that really are much more important than they were in the past. If anything, one of the things that happened this year is the capital markets, the limited partners, the investors in real estate funds woke up to the importance of ESG. And it's not just about environmental. While environmental, in some respects, may be the primary financial driver or fiscal driver, social, thinking about diversity in the workplace, is of critical importance to the long-term stability and long-term health of an organization. And then corporate governance, a very similar thing. These are all trends, and these are all really important factors that people focus on. And ESG is now a term that I think most investors, most companies, most CEOs are very familiar with. So how do we think about ESG? How do we think about creating sustainable value? At the start, as I said, LPs are really focused on ESG. We started 2020 with Larry Fink from BlackRock writing a letter that was very similar to the letter he wrote a year ago, but we were finally ready to receive and listen to the message. A week later, Steve Schwartzman from Blackstone gave an interview to the Wall Street Journal at Davos, where he basically said sustainability is simply good financial practice. This is simply something that we do as good investors. And that trend has only accelerated over the course of this year. COVID hasn't caused people to say we care less. They've basically said, not only do we care more. And if you don't do it, you're not getting our capital. So it's about access to equity. It's about not necessarily access to debt, but better terms for debt, higher proceeds, lower reserves, lower interest rate. And so, but the investors, there are a number of things they want. They want better data. They want to know what you're doing. They want to have a way to, certify what you're doing. As we think about it, ESG is creating value in the short term and the long term. It's part of a risk mitigation strategy for companies. And the reason LPs are demanding it is because they really want to align their view of climate and their focus on climate with how they're investing. This is what's driving the green bonds to hundreds of billions of dollars in activity this year. This is what's driving programs like Fannie Mae and Freddie Mac in the US, RBS in the multifamily in the UK, and lots of other financial institutions that are looking for and developing climate-linked products. And when it's done right, it does a bunch of things. It lowers your operating costs at the most basic level. But if you're a fund, it also helps with your fundraising. And if you've ever done fundraising, then either you're going to raise more money with an ESG integrated strategy, or you're going to raise the same amount of money, but quicker. And time matters. And if you can shave 3 months off of your fundraising, this is a really important thing. And it also drives your brand of your organization. It makes your organization better in terms of its ability to attract people to work for it, to attract capital, to impact your community. So let me spend a minute and talk about sort of where this comes up. There are 5 stages, 5 steps where we think ESG needs to be incorporated or embedded in real estate. First, when you're designing it, we often see a tension between life cycle and first cost. So when you go to value engineer a project, the very first things that are removed often are the high performance things, the things that have the biggest climate impact. And what we often see is that you end up saving $1 million on your construction budget, but now because while the building looks the same, it performs at a lower level, you may have increased your operating cost by $100,000. When you do that and you put a cap rate on that, leaving lease structure aside, you've saved $1 million, but now you may have destroyed 1.7 million at a 6 cap of equity value. It's important to understand that every design decision is in fact also a financial decision. We increasingly are doing more work around acquisition due diligence. The PCA, which is something that really everybody watching will have done if they've bought a building, identifies the costs. It identifies the reserves that should be established, the so-called 10-year grid that we all see. What it never has done is it's never identified the fiscal or financial impact of those measures. So it'll say in year 4, reserve $400,000 for a BMS. What it doesn't do is basically say a BMS in a particular market might have a 20% rebate and it might save you $50,000 a year. So now all of a sudden you're talking about a 5.5 year payback, which may be very well accretive to the asset. It may not be something that you want to defer or wait, but it actually will not only make the asset better, but it will actually make the asset more valuable. Also, as I mentioned, financing. Increasingly, we're seeing people want to make sure that the ESG opportunity also is incorporated into the financing. So whether it's a Fannie or Freddie, which has the so-called supplemental, giving you basically more proceeds and more debt if a portion of it goes to ESG, but also a lower interest rate. This is something that can create a lot of value, either higher proceeds, lower interest rate, lower cost of capital, which we don't see enough people taking advantage of. And then there's the traditional place, the hold period. You own an existing asset, you assess it, you engineer the solution, you identify the savings, the rebates and incentives, and you go execute the project. This is what we've always done. These earlier steps are all things that we're starting to see much more ubiquitous in the market. And then finally, disposition. And that's both measuring and verifying the work you've already done so people can be very clear that they're getting the economic impact. But it's also about identifying projects that may not have yet been carried out. And all of us have been subject to, and perhaps on the other side of retrades, where you've identified an issue you want, say, $2 million to cover the cost of doing the work. We've had people bringing us in to both clarify the savings, but also to clarify the cost and the rebate. So instead of it being 1 to 2, they can now say with certainty, we agree, we understand, but actually we know with certainty it's $1.2 million. So we're not giving you a $2 million price cut. This is increasingly important in a world of sophisticated assets and transactions. So let me just take you through a financial example of what this all means. This is an office building that we worked on. It's actually the Baltimore, Maryland FBI field office. We did this project a few years ago for a private REIT that brought us in. I like this example both because the scope of work we did really touches everything. It's lighting, it's controls, it's building envelope, it's mechanical systems. But it's also a great example of creating financial value. So this project in rough numbers cost $300,000. It saved about $100,000 a year. So basically a 3-year simple payback. Now, we were able to secure from BG&E, the local utility, $100,000 of rebates and incentives, leaving a net cost of $200,000. Now, the owner could have paid the $200,000, but we helped identify and show them that actually their mortgage had CapEx reserves well in excess of the $200,000, and with a modified GSA gross lease, we got the lender to get comfortable with releasing those reserves to us. Lenders hate releasing reserves, but this lender understood that by doing so, they actually ended up with a better loan because that $100,000 of OPEX reduction was an increase in EBITDA, and at a 6 cap was nearly $1.7 million of NAV or equity increase. And so while they gave up the reserves, they ended up with a collateral value that was much higher and a loan to value that was now much lower, making this a better quality loan, even though they had fewer reserves. And this, was a perfect example, I think, of the value creation. Now, at the same time, there were softer ROIs. This building had a variety of sort of thermal and building envelope issues. It had eye strain because of lighting levels. All those were mitigated by the solution, and GSA and FBI were much happier with the building, with the owner, which also then resulted in them exercising an expansion right, basically to renew. And so now the owner had 10 more years of term on their lease, which they were able to use for a capital event soon thereafter. Let's just talk for a moment about COVID. COVID has created opportunities that we honestly never expected to see. We've seen tenant uncertainty and they've moved away from the office. We've seen insurance costs go up essentially across the board. In senior living, much higher, but still in office, because the insurers are basically saying now there's a new risk, an increased risk of claims associated with COVID. And if that claim happens without therapeutics and without a vaccine, the cost of that will be very high. And then finally, you've got lots of people sort of trying to figure out what technology to integrate into the buildings, how to do it to address all these concerns. And the minute you've got these new impositions, these new costs, are the minute that you've created opportunity. If insurance costs go up, we now have another cost in the income statement, another line item that we can mitigate and reduce to drive a value. We've thought a lot about this over the course of the year, and the challenge is essentially no one really knows what a better building looks like. No one knows what better air quality is. No one knows what better cleaning is. And businesses have to make a decision. They can't just eliminate all the risk. They can mitigate it. So how do they create trust with their stakeholders? What can they do to create a multi-layered approach? And when we say multi-layered, we really think about how do we get people to find different ways to create this sort of overlay of multi-sensory trust. Critical to own your narrative, tell the story that people want to hear. And then finally, if you do this right, and we're working with lots of our clients around this, we actually think that not only do you create value, but you create what we call the real estate company of the future. Because we're in a unique moment in time. Increased focus on health, socioeconomic. But as I think we all would agree, it's very clear now that the government isn't going to solve this. And so the business community has been thrust into much more of a leadership role than perhaps they would have expected. But if they do it right, it creates opportunities to capture new customers and drive the value of their business. And so we have to do it. What does this mean? So for us, this has really been about 4 things. It's been about technology. What technology should we be putting in the building? And that means perhaps better airflow, better air filters, better cleaning. We need to do lots of things to mitigate all the concerns that people have. But no one really knows what this means. So now we're in a position to acquire and collect better data. Better data on air quality, for instance, VOCs, CO2, fine particulate matter, humidity. No one really knows what the right number is. They don't even know how to analyze that. So we're also working with them to do 2 things. One, to verify so that people understand that from an ESG and health and safety point of view, there's a third party actually looking at this saying, yeah, they're doing a good job. But perhaps the most important piece is how do you communicate that? As this began in March, we spent lots of time thinking about this, and we recognize that people take in information 5 ways. And there's only 5 ways, the 5 senses. You can hear it, you can see it, you can smell it, you can taste it, you can touch it. And the best way to address all these concerns is to hit these in a multiple sense. It's not just enough for you to hear it, you need to see it. Sight is really important. Sound is good. Smell, as an example, is actually one of those things that actually is much quicker. It's a much faster response than almost anything else that you've got in terms of senses. We joke that, in the past, people have been about sandalwood and rose and softer scents. Now the scent that people want to smell when they go into a hotel or their office, they want to smell something that's much more hygienic. Clorox, bleach, those are the new scents. Those are the things that trigger this sort of S1 thinking that you immediately know the building is actually clean. Touch. When you get to a building, you need to absolutely be certain that that first step inside the building is a clean one. If there's no grit, there's no anything else. And in some ways, this starts right at the beginning. Before you even get into the office building, you're going to be primed by looking around to basically understand, is it likely to be safe for me? I'm actually quite surprised by the number of hotel companies that are focused on communicating how they're going to clean rooms. I think that's really important. But my perspective is really, once you're in the room, all you're doing is confirming a sense that you had to even get there. Because you've got to get me to book the room. You've got to get me to walk in the hotel, check in, walk through the lobby, and go up through the elevator. By the time I get to the room, I'm pretty comfortable that this is a safe environment. I only need you to confirm it. You're not likely to make me even more comfortable. So, Zach, I will stop there and make sure that we've got enough time for any questions that people might have.
Thank you very much. Thank you, Bradford. It was an excellent presentation. I really appreciate you here again. I think we're going to direct questions and answers to the Slack channel. So I encourage everybody to please shoot your questions over to Bradford in the Slack channel now, later in the day, anytime. So again, Bradford, many, many thanks.
All right, Zach, thanks so much.